Thomas Verbraken, you are Executive Director in Risk Management Solutions Research at MSCI. Thank you for joining us on BiTV.
I'm pleasure being here. Thank you for having me.
Uh, in a recent blog post, you addressed how Eurozone inflation and ECB policy could impact real estate markets. In the face of the current uncertain economic environment, what are the main scenarios? Scenarios do you foresee for the coming months?
Um, yeah, well, I will first start by saying that scenario analysis is really becoming a popular tool to understand how macroeconomic and geopolitical events can impact financial portfolios. And because forecasting is very hard, we have developed different narratives for how Eurozone inflation and ECB policy could potentially play out in the coming months. And in those scenarios, we basically have two important elements. The first is the nature of the macroeconomic shock. So in the past decade, we saw more like demand-driven shocks where growth and inflation move in the same direction. For example, after the great financial crisis, we've seen low inflation and GDP growth has also not been very strong. But now coming out of the COVID pandemic restrictions and especially after the invasion of Russia into Ukraine, inflation has skyrocketed, and we also see significant headwinds to economic growth. So this is more of a supply-driven shock to the economy in which inflation and growth move opposite to one another. And that puts central banks in a more difficult spot because if they are tightening monetary policy to curb inflation, they will also, create some difficulties for the economy. And that brings me to the second important element of our narrative, namely the central bank policy and the credibility of central banks. So it's really important how investors and consumers will perceive the European Central Bank's monetary policy and tightening of monetary policy, so to say, because in a scenario where investors and consumers perceive the ECB is not aggressive enough, long-term inflation could really remain elevated, and that could really have an impact, a negative impact to long-term economic growth as well. And then, the last thing I want to mention is that in Europe, we have another challenge, namely the fragmentation risks, as they call them, which means that when the ECB is tightening monetary policy, countries might be impacted differently in terms of their sovereign borrowing costs, and it could bring some countries, like for example Italy, into trouble. And the ECB will have to, they will also, they explicitly mentioned they will take this into account, but it seems they have a little less leeway than other central banks in their battle against inflation.
Mm, okay. And therefore, according to MSCI's predictive analysis, how could this scenario impact real estate investors?
Um, well, we use our macro finance model to paint a few scenarios. And we basically have a range of scenarios, right? We don't do forecasting in the sense that we say what will happen. We say
Yeah.
various things could happen, and if that happens, that's how investment portfolios and real estate as an asset class could be impacted. And it goes from an optimistic soft landing scenario, which I think now fewer and fewer people still believe in, and then we have scenarios, a scenario in which there is this decisive tightening by the ECB, which brings inflation down, but has some short-term headwinds to the economy. And then there is the word that all investors fear, the stagflation scenario, in which the ECB monetary tightening is considered to be insufficient. And what I mentioned earlier, we have this rise in expectations, in long-term inflation expectations, and also like a hit to long-term economic growth. So how does that impact markets? Well, um, and before I go into the numbers, I would like to say that these scenarios are meant to be interpreted over a medium horizon of, let's say, a couple of months, and they really focus on the fundamentals, so the
Mm,
macroeconomic situation, not so much on the daily volatility we see in markets. Like we see really swings up and down nowadays, but we focus a bit longer term. And what we see is that, for example, the soft landing, it's a good scenario in the sense that equities and bonds, sovereign bonds go up, they gain. In the stagflation scenario, we see equities and bonds lose at the
mm,
same time. So that's kind of the broad market impact. And to come to your question, the real estate asset class. So to say something about that asset class, we basically leverage the risk models to understand how real estate assets move together and how they are correlated to market factors like equities, yields, currency, and so on. And we basically propagate those shocks on equities, sovereign bonds, etc., to the real estate asset class. And as an example, we apply the scenarios to the MSCI Pan-European Quarterly Property Fund Index. And we see that the impact for that hypothetical portfolio goes from a 6% gain in the soft landing scenario to a 7% loss under the stagflation scenario, with losses of around 2% under the other scenarios, relative to expectations before these additional macroeconomic shocks.
Okay. How could real estate assets compare maybe to other investment products in the current economic context then?
That's a very good question. And well, real estate is sometimes thought of as a bond-like asset class because of the steady stream of cash flow that it generates. But whilst the short-term kind of income may be more bond-like, may be sticky, in the longer term, the cash flows are not fixed and they depend on economic growth. So that's an important thing to notice. So with weaker economic growth, future income could be impacted, and that's why real estate leans closer to equity as an asset class than some investors might realize. So if we take a step back, real estate valuations can be impacted by two things. One is this future income stream, which might be smaller than expected because of the impact of economic growth. And then there is a discount rate, which we use to basically calculate the net present value of that income stream. And if you look at those two factors and how they impact real estate valuations, then in the context of historical data, we've seen that economic growth and the impact of that on the income stream has typically a stronger impact on the real estate asset valuations than the discounting effect. So to get back to the inflation topic, and in that context, I think often real estate is seen as an inflation hedge. But unfortunately, in scenarios where this high inflation coincides with weak growth, this future income could turn out lower than expected, and that would, of course, that puts downward pressure on the valuations. You can think of it as a inflation being a tax on consumption, which leaves less budget for paying the rent, basically. So that's one element, and at the same time, we have the potential for increased interest rates, which then has a negative impact through the discount factor. So that's, I think, what's really the reason why the stagflation scenario is, I wouldn't say scary, but it's not a very good one, because we have both that weak growth combined with upward pressure on interest rates. So it's a double hit to real estate as an asset class. And if we look at it in terms of kind of the magnitude of the impact, according to our scenarios, then we see that real estate falls in between sovereign bonds as an asset class and equity. So it won't lose as much as equities, but it will lose more than the sovereign bonds under our stagflation scenario. So that's kind of maybe in summary, like, well, to have one key takeaway, I would say that real estate as an asset class is sensitive to economic growth and has some similarity to equities in that sense. And because of this growth sensitivity, it might not be such a great inflation hedge as is sometimes thought. So watch out, I would say.
All right. Well, thank you very much for this insight. I see there is still a lot of uncertainty, but thank you for helping us see a little bit clearer through the economic fog, if you will. Thank you all for joining us as well, and see you soon on BiTV.
Thank you very much.